In this video, you will learn the two crucial rules of investing. And if you follow these rules, nothing can happen, practically speaking. If you don't follow these rules, you're taking big risks and you might be not aware of these risks. So let's find out together. Rule 1. If we talk about mutual funds, stock or ETF investment, the first rule is definitely long term. So long term means at least 7 years. Better would be at least 10 years in the stock market. Why? Well, how do stocks perform? Let's say this would be a typical stock chart. Okay? This is how stocks perform. And let's say this is 10 years. And this is the value of the stock. So this is time and this is value. So now let's say you're investing in stocks for over, let's say, 3 years. Might be the case at that point that you lose money. So if you're planning, for example, to buy real estate in 3 years, or that you would like to save some equity because in 3 years you have to refinance your mortgage, or you just would like to build wealth over the next 3 years, stock investment wouldn't be the correct solution. Because might be the case that you made a lot of profit, but might be the case that you also lose money. And this is something you should definitely avoid. If you invest in stocks or ETFs in 3 years, it's more like hoping and more like gambling in comparison to actually making informed investment decisions. But if you do it long term, well, obviously this is the performance on average, and this obviously makes a lot of sense. So first rule, long term. Second rule is diversification. Diversification in, let's say, countries, currencies, sectors, or let's say industries. So you don't have any cluster risk, okay? Because let's say you're only investing in one country. We have many Indian clients, for example, and many invest in India, which definitely makes a lot of sense because there is a huge growing market, and this is fully understandable and definitely recommended. However, I wouldn't rely fully on one country and also one currency, because we are living in tough times right now. And I also meet many Ukrainian people, and unfortunately they lost everything because the currency lost its value. Real estate lost its value. The stock market is obviously not performing because of the issues. So this is a big problem. And if we're talking about investments, let's say for your retirement, okay, who can actually guarantee that a specific country is performing well over the next 30 years? No one. You might think that this country will perform really well, but you actually don't know. And this is something what I've meant in the beginning. You are relying on hope and not making informed decisions or in any belief. I don't want to say that, for example, India is not performing well long term, but who knows if there is any unrest with neighboring countries in the future. Okay, we see that currently in many places in the world where there are issues between neighboring countries. I don't want to be political here. I'm just talking from the investment perspective here. So if you are fully relying on one country with your whole assets and especially one currency, and even worse, also only one sector. So let's say you invest in India, in rupees and you only invest in the IT sector. Okay, now you have 3 cluster risks, which means if the IT sector is not performing well at a certain point, you will lose money. If the currency is not performing well at a certain point, you will lose money. Or if the country is not performing well because of any unrest with a neighboring country, you would also lose money. So what I would highly recommend is, for example, if you, let's do it like this. If you invest, for example, in India, then you should reconsider if 100% of your assets should be invested there. Because yeah, you have higher profits, for sure, but you also have a potential higher risk, which comes along with higher profits. Okay? Why is a bank giving you 10% guaranteed interest rate, and on the other side charging for a loan 12, 13, 14%? Because it's also risk for them. If for example, a bank in a country where the bank is paying high interest rates even on savings deposit, but is charging high interest on the mortgage, is that they don't fully believe long term in that potential. Because if they would fully believe, they wouldn't charge 14% interest on the mortgage, because this is their risk. They are giving you money for 14% interest rate, as an example. So if they do so, this means that they are themselves not fully convinced that the people in that country are able to finish the loan, for example, in 20 years. Because the future is uncertain for every country. And that's the reason when even banks say, I'm not quite sure, let me charge my 14%, because if you're unable to repay the loan after 5 years, I made 14% profit over 5 years. Okay, then I sell the property, I'm fine. Okay? So I would definitely reconsider my portfolio if any cluster risk is attached to your portfolio, or if you say, well, I was about to invest over the next 5 years, but the markets were performing really well in the last 5 years. Well, this is one really common mistake actually in the investment area. Let's put it here. Mistake. Making predictions for the future because of the past. It actually, for investments, it actually doesn't it's not necessary to look at the past. It has no impact on the future, typically. Because just if the investments performed really well in the last 5 years, doesn't necessarily mean that they will perform bad in the next 5 years, good in the next 5 years. And the other way around. Let's say investments performed really badly in the last 5 years. Well, it doesn't mean that they're not interesting investments. Maybe they are particularly interesting right now because they were performing badly in the last 5 years. Okay? So yes, this is really important. If you follow these 2 rules, nothing can happen. You might have lower profits in comparison to taking more risks. Yes, but you will definitely reach your financial goals. Because you have 2 options. Either option 1, you are taking risks to either achieve your financial goals faster, but also that you have the scenario that you're not achieving your financial goals at all. Because at 50, at 55, when you would like to retire, for example, something happens to the stock market, and then you have a big problem. And you don't have enough time to recover from these drawbacks because you would like to retire at that point. Or option 2, it might take longer in comparison to riskier investments. Yes, but you're definitely in a position to reach your financial goals. So now you can decide, are you willing to take big risks? Or do you say, I'm taking lower risks, but I'm definitely on the safe side to be in a position to achieve certain financial goals? If you would like to have help to create an investment strategy for you, which optimizes profits, returns in comparison to a certain risk appetite, and you're not quite sure if you're maximizing all the potential benefits without taking big risks, feel free to register for a free initial consultation on our website. We're happy to help to optimize your investment portfolio. Talk to you soon.